So, hi all. In the last video, we looked at the CAPM model. The idea was very simple. Investors should be compensated for taking systematic risk, and beta measures how much exposure an investment has to that risk. But there's a problem. What if the beta is not enough? For example, what if two companies with the same beta can systematically generate different returns? And what if there are other characteristics of companies that help explain why some stocks outperform others? Well, that's where the Fama-French model comes in. In this video, we're going to take a look at what Fama-French actually is, why it was developed, how the factors work, and why it fundamentally changed the way economists think about stock returns. So let's quickly recap the CAPM. The capital asset pricing model says that the expected return of an asset depends on the risk-free rate, its beta, and the market risk premium. In other words, higher exposure to market risk should mean higher expected returns. The problem is that when researchers started looking at actual stock market data, they found something different. Beta didn't seem to explain everything. Stocks with similar betas could produce very different returns. And more importantly, certain characteristics appeared to be associated with higher average returns over long periods of time. One of the most famous examples was company size. So, smaller companies on average appeared to generate higher returns than larger companies. Another was valuation. Stocks that looked cheap relative to their fundamentals tended to outperform stocks that looked expensive. These observations created a problem for a model that relied primarily on market beta. So, in 1992, economists Eugene Fama and Kenneth French published an influential paper examining the relationship between stock returns and factors such as market beta, company size, and valuation. Then, in 1993, they formalized what became known as the Fama-French three-factor model. Instead of saying market risk explains stock returns, the model essentially asked, what other systematic patterns help explain differences in stock returns? The answer in the original three-factor model was three different factors. Those are market, size, and value. Now, let's take a look at them one at each time. So, the first factor in the market is the market factor. And this is essentially the same basic idea we encounter in the CAPM. A stock return is partly related to return of the overall market. If the market rises, many stocks rise with it. If the market falls, many stocks fall with it. In the Fama-French model, this is represented by the market axis return. So market return minus the risk-free rate. So the first factor is very similar, but now Fama and French add two additional factors. So that first additional factor is size. This is usually represented by something called the SMB, the small minus big. The idea is very straightforward. Researchers divide companies into smaller and larger firms, and then they compare the returns of the two groups. As small companies outperform large companies, the SMB factor is positive. But why might size really matter? Well, there are several possible explanations for this. Smaller companies may be more financially constrained, they may have less diversified businesses, may have less access to capital, or they may be more vulnerable to economic shocks. In other words, perhaps small companies are genuinely riskier in ways that CAPM single beta doesn't fully capture. But there's an important distinction. The Fama-French model is primarily an empirical model. It tells us the relationship exists in the data. It doesn't necessarily tell us exactly why that relationship exists, but that distinction becomes important when interpreting factor models. And the third factor is value. So this is represented by the HML, or the high minus low. Here, high and low refer to book-to-market ratio. A company with a high book-to-market ratio tends to be considered a value stock. A company with a low book-to-market ratio tends to be considered a growth stock. The basic empirical finding was that value stocks tend to outperform growth stocks over long periods. But again, why? Well, one possibility is risk. Perhaps value companies are more distressed and therefore require higher expected returns. Another possibility is that investors systematically overpay for attractive growth companies and underprice less exciting businesses. Regardless of the explanation, the pattern appeared in the data, and that was the key insight. So market beta alone wasn't telling the whole story. So let's put all of these together. The Fama-French three-factor model can be written as the um, expected return, expected excess return of the investment is equal to the market risk premium times its beta, plus the SMB times the beta, and the HML times the beta. And conceptually, this says an investment's excess return can be explained by its exposure to three systematic factors, being the market, the size, and the value. The coefficients in front of each factor are the stock sensitivities to those factors. So imagine a company with a high sensitivity to the market factor, a high sensitivity to the size factor, and a high sensitivity to the value factor. Well, that model would predict that its expected return should reflect all three exposures. This is a major conceptual shift from the CAPM, because the CAPM essentially gives us one major risk factor, the market, while the Fama-French gives us three. So, in order to make this intuitive, imagine two companies. Company A is a huge technology company trading at a very high valuation, whereas Company B is a small industrial company trading at a relatively low valuation. Suppose both companies have the same market beta. CAPM would therefore predict broadly similar required returns, assuming the other inputs are identical. But the Fama-French model says, wait, Company B has exposure to the size factor because it is small, and it has exposure to the value factor because it is relatively cheap. Those additional exposures may help explain why its expected returns differs from Company A's. So instead of looking at only one dimension of risk, we now have several. It's a little like moving from a two-dimensional map to a three-dimensional one. We're able to explain more of the valuation and stock returns. But the Fama-French didn't stop there. In 2015, Fama and French introduced an expanded five-factor model. The original market, size, and value factors remained, but two additional factors were added: profitability and investment. The profitability factor is commonly called the RMW, the robust minus weak. It captures differences between companies with stronger and weaker profitability. And the investment factor is called CMA, the conservative minus aggressive. And this captures differences between companies that invest relatively conservatively and companies that invest aggressively. So the five-factor model essentially asks whether returns can be explained by market, size, value, profitability, and investment. This is much richer than the original CAPM framework. So why does this really matter? Because factor models fundamentally change the way investors and academics think about portfolio returns. Instead of simply asking, did this portfolio outperform the market, we can ask, what exposures generated that return? For example, imagine a portfolio manager earns 15% in 1 year. That sounds very impressive. But what if the portfolio was heavily exposed to small companies and value stocks, both of which happen to perform extremely well that year? Well, then the manager may not have generated as much genuine stock picking alpha as the 15% headline return suggests. Factor models help separate systematic factor exposure from what we might call abnormal performance, or alpha. This idea is now deeply embedded in modern quantitative investing. And so, finally, looking at some different limitations. The Fama-French model, just like the CAPM, is imperfect. The factors are based on historical relationships, and historical relationships don't necessarily continue forever. There are also debates about why these factors exist in the first place. Are they, for example, compensation for risk? Are they a result of investor behavioral biases? Or are they partly caused by data mining and methodological choices? And there are many other factors researchers have proposed beyond the original five. Momentum is one of the very famous ones. Quality is also another. So there isn't one universally accepted list of factors that completely explain stock returns. So in conclusion, the big takeaway is this. The CAPM tells us that market risk measured through beta should determine expected returns. On the other hand, the Fama-French says that's not enough. Size and value help explain differences in returns, and the later five-factor model adds profitability and investment. The broader lesson is perhaps even more important. Financial markets are complicated. No single variable is likely to explain everything, and that's exactly why factor models remain such an important part of modern finance. If you want to understand the next step, the obvious question is, what exactly is the alpha, and can investors actually generate it? That's what we'll look at next. Subscribe to The College Economist for more economics, finance, and investing explained simply. Thank you for watching.